Hi everyone, welcome back to the channel. This video is a part of the monthly portfolio update series that is made for the benefit of the individuals invested with me on Etoro about the portfolio performance over the past month, the current holdings in the portfolio, and my expectation about how the portfolio will fare moving forward. At the moment, I've got just around 500 individuals invested with me. If you are someone who is not invested with me on Etoro and you are interested to know more about the platform and how you could be invested with me, there is a link to another video in the description below that goes over that. For the month of August, the portfolio is down 2.5%, and for the year, the portfolio is up 84%. I wanted to address something before getting into the portfolio holdings. Recently, I've been receiving quite a few messages from people who are clearly upset with the portfolio performance over the last few months. Maybe they were not aware about my approach towards managing the Etoro portfolio, so I thought it would be a good idea to just reiterate that. My approach is quite simply looking for investments where the probability of downside is low, but there is also tremendous upside. Basically looking for low risk, high return opportunities rather than the traditional high risk, high return situation. It is an approach that requires a concentrated portfolio where it is possible that I underperform for a long time period and then suddenly outperform very quickly. It is definitely not an approach that is right for everyone, but because I have my own money invested here, I'll be investing in the manner where I can see the probability of getting the best risk-adjusted returns over the long term. There are plenty of other fantastic, very intelligent PIs on Etoro who can deliver green months consistently. However, getting green months is not my goal at all, and I am not one of those PIs. I am not the kind of investor who holds like 50 or 100 companies in the portfolio and hopes that things work out well. I like knowing the companies that I'm invested in. I like studying the management and the possible catalysts that could unlock value. So please take the time and assess if my investment style resonates with you before investing with me. Your performance is linked to the personality of the investor as much as it is to the portfolio holdings. With that, let's get to the portfolio holdings. We now have 7 companies and 1 ETF in the portfolio. The new additions this month are Seritage Growth Properties, Equity Commonwealth, and Prosus. Let's start with Equity Commonwealth, which is roughly 10% of the overall portfolio. Equity Commonwealth is classified as a REIT, which is a real estate investment trust, but in reality, it is a lot more like a cash shell that is managed by legendary real estate investor Sam Zell. I had made a video explaining the entire history behind Equity Commonwealth, so you could check that out if you are interested in learning the entire investment case for the company. So what's happening right now with Equity Commonwealth is that their current market capitalization is right around cash value. They also own 4 commercial properties, which most likely they will be selling off in the not too distant future. The plan for the company is to acquire Monmouth Realty and then pivot into being a player in the industrial property sector. The merger is still ongoing and there's a lot of back and forth between the two companies and a couple of activists who are trying to kind of get in the middle of this entire merger agreement. I personally believe that Sam Zell and the team will most probably be able to close this merger successfully within the next few months or so. And from there, they're probably going to go on and acquire maybe another real estate company or other properties and fuel the growth for Equity Commonwealth. Our downside with this investment is very limited because it is already trading right around the value of the tangible cash and real estate that they control. The upside with this investment could be extremely large as management continues to make sensible deals within this industrial sector. The next new addition to the portfolio is Seritage Growth Properties. Seritage is also another REIT, but it is in a bit of a strange situation. Seritage was spun off from Sears back in 2015. All the massive Sears superstores were transferred to Seritage, and since then, the primary objective has been to redevelop these vacant massive shopping malls and turn them into mixed-use properties. The reason for doing this is because many of the properties are in prime locations where the density could be dramatically increased, and Seritage could also charge a meaningfully higher rate per square foot. The main problem that a lot of people have with Seritage is the amount of debt that the company has. The company does have a lot of debt outstanding, which is around 1.6 billion on a total enterprise value of just over 2.1 billion. But a key insight about this debt is that it is completely held by only one party, which is Warren Buffett's Berkshire Hathaway. Last year, Seritage had breached the debt covenants in place, yet Berkshire Hathaway allowed the company to defer the interest payments rather than just go out and capture the assets of the company, which they very well could have done. What this action signaled to me was that Seritage essentially could not go bankrupt because their only debt holder was willing to work with them rather than against them. My perspective is that Seritage could have a value somewhere between $30 to $40 per share within the next 3 years or so, which is a double from our buy price of roughly $15. I have made quite a few videos in the past about Seritage, so do feel free to check those out if you're interested in the investment case for the company. The last of the new additions to the portfolio is Prosus. Prosus is an investment company that is based in the Netherlands. What's unique about Prosus is that it was also formed as a spin-off from a South African company called Naspers. Naspers is largely known for being an early investor in the Chinese internet giant Tencent. Naspers used to control a 1/3 stake in Tencent. They then decided to transfer that entire stake to Prosus along with a bunch of venture capital investments. What Prosus has been doing is selling off fractions of the Tencent stake and then reinvesting the proceeds back into high growth opportunities in emerging markets, such as its recent action of acquiring India's BillDesk for 4.7 billion. When looking at the investment case for Prosus, I view it through 3 different lenses. The first is the lens of the past, which comprises of its stake in Tencent and can be viewed as a source of dividend income and cash from capital gains that will be used to fund future deals. The lens of the present is one that is focused on buybacks, which Prosus has been aggressively pursuing. 2 weeks ago, on the 23rd of August, the company announced a further $5 billion share buyback program that would continue till August of next year. Buybacks are a great way for a company to return money to its shareholders, and frankly, this is the reason that I am interested in Prosus right now as an investment, because of good capital allocation. When we look at the company from the lens of the future, they are essentially funding a whole bunch of relatively small companies in emerging markets in the hope that maybe a few of them do exceptionally well, exactly like their Tencent investment has. So in the short term, it's basically like investing into Tencent. But over time, the investment case for Prosus will dramatically change as the current smaller investments come to fruition over time. Moving on to another portfolio holding, Alibaba, the portfolio position that has been the primary driver behind the recent losses. Just over the last month, the stock has fallen more than 20%, and I have been buying all the way down. The reason that I have been buying is because what I'm seeing is a great business that has a whole cloud of fear, uncertainty, and doubt surrounding it due to the new regulations in place. There is a great investor by the name of Howard Marks who has a fantastic quote that applies here. It is not what you buy, it is what you pay for it that determines whether something is a good investment. So let's think about what we are getting when we're buying Alibaba. We get a core e-commerce business that is expected to grow at double digits with a very long runway. We get a company that has a fortress balance sheet that is able to pay off all its current liabilities very quickly. We get an investment portfolio that has an impact on a global scale. We get a cloud business that could potentially be the most dominant cloud services provider globally within a few years. We also get access to one of the most dominant payment processing companies due to the 1/3 stake in Ant Group controlled by Alibaba. But of course, all of this potential is walled off by something called a VIE structure, which refers to the variable interest entity structure, where foreign investors do not directly have access to owning Chinese equities. The existence of the VIE structure, coupled with the intense scrutiny by regulators, is the reason that stocks of all Chinese companies, not just Alibaba, have been free falling over the past 6 months. In my view, the collapse of this VIE structure seems like an irrational risk, which is unlikely to materialize. Even the possible delisting of Alibaba from the American markets will adversely impact all parties involved, not just Alibaba. So again, it's more of a systemic risk rather than a company-specific risk. I believe that in the long term, the share price of a company follows the growth in earnings. and Alibaba has the probability of being a much more dominant company 5-10 years out, irrespective of any regulations that may seem scary right now. Unless something fundamentally changes that impacts the future economic prospects of the business, I intend on holding onto Alibaba in the portfolio for a long time. Moving on to the final portfolio position that I'll be covering today, our largest holding, Bill Ackman's Pershing Square holdings. There is a very high probability that we will make excellent returns during this month and in October, primarily driven by Pershing Square holdings. The reason for that is the recent deal that Bill Ackman was able to structure where PSH received the purchase agreement from PSTH to buy 10% of Universal Music Group from Vivendi. UMG will be publicly listed on the 27th of this month, and it is expected to trade above the deal price that PSH was able to obtain the shares at. At present, the net asset value of PSH is accounting for the UMG shares at the deal price. After UMG is publicly listed, the NAV will revise to the listed price of UMG, which is expected to be significantly higher. What this means is that we will probably earn a good return as PSH shareholders towards the end of this month. So with that, I hope that you've got a better idea about how I'm viewing the companies in the portfolio. If you've got any questions, do share them in the comments below, or feel free to reach out to me on Instagram or on Twitter through the links in the description below. Thanks for taking the time to watch this update and have a great day.